Today on Real Estate Backstage, the labor market remains resilient as we get a stronger than expected April jobs report. GDP contracted in the first quarter, but it's actually not as bad as it sounds. A bipartisan bill seeks to give advantages to first-time homebuyers, and Compass files a lawsuit against the Northwest MLS. Before we jump in, if you're watching on YouTube or if you're listening on Apple Podcasts or Spotify, go ahead and subscribe to the show. That way you don't miss any future episodes. And if you're looking for the show notes with links to all of the articles that we're going to reference today, you can find that at realestatebackstage.com/episode 27. Now, if this is your first time watching or listening, I'm your host. I'm Michael Smith, CEO and broker in charge here at Bluefield Realty Group. And we're a three-time Inc. 5000 company headquartered here in Greenville, South Carolina. And we provide real estate brokerage, property management, and insurance services. All right, so let's jump in today with the jobs report for April. This is hot off the press. According to Connect CRE, quote, non-farm payrolls for April printed at 177,000, and the unemployment rate remained steady at 4.2%, reported the U.S. Bureau of Labor Statistics. Expectations were for a 133,000 rise, a notable decline from March's stronger than expected 228,000 gain. The March and February reports were both revised lower to 185,000 and 102,000 respectively. The economy has added about 193,000 jobs per month on average over the last 6 months. The April report was the first since President Trump's Liberation Day tariff announcement on April 2nd, which introduced uncertainty due to potential trade disruptions. However, the data has yet to fully reflect tariff impacts, as these typically manifest over months. The initial reaction in the market has been positive, with stock futures, the 10-year Treasury yield, crude oil, gold, and the dollar all higher, unquote. So this is good news for the economy. The report came in a little bit stronger than expected. We did get a couple downward revisions for the February and March numbers, which is never a good thing, but the actual number of new jobs being added was pretty strong. Unemployment rate held steady. The overall labor market has been slowly softening, but definitely not breaking. However, like the article said, it's important to remember that it will take several months at least for the true impact of the trade war to really work its way through the economy and to start showing up in the backward-looking data. If the labor market continues to remain resilient, there's really not much reason for the Fed to loosen up its restrictive policy, at least not without inflation getting down to its 2% target. So we'll continue to keep an eye on the labor market as always. Now, this is according to Housing Wire. Quote, a bipartisan duo of U.S. senators on Tuesday introduced a bill aimed at expanding housing affordability for first-time homebuyers, the latest example of a bipartisan legislative effort focused on the cost of housing. The Affordable Housing Bond Enhancement Act, which Senators Catherine Cortez Masto, a Democrat from Nevada, and Bill Cassidy, a Republican from Louisiana, introduced together in 2023, has been reintroduced into the Senate as the pair aims to expand housing affordability options for first-time homebuyers through the expansion of two federal programs, the Mortgage Revenue Bond Program and the Mortgage Credit Certificate Program. The MRB program helps prospective homebuyers who are at a certain area's median income who may not have enough money to meet down payment and closing costs. It features mortgage loans with interest rates that are below market rates. The MCC is a tax credit program, which comes in the form of certificates issued by housing finance agencies that increase the federal tax benefits of owning a home and helps low-income and moderate-income first-time homebuyers offset a portion of the amount they owe in mortgage interest, unquote. So like always, it seems like all of the legislative efforts to address the homeownership affordability crisis, it's always on the demand side of the equation. They're always trying to subsidize and make it easier for people to buy a home through providing some type of financial assistance. Now, this is great for the people that happen to receive the assistance. However, keep in mind, housing is unaffordable because there is such an imbalance between supply and demand. If housing is unaffordable and all we do is continue to subsidize demand on the buy side of the equation, that's just going to continue providing additional upward pressure on pricing. Unless we actually address the supply side of the equation, we're always going to be stuck in this unaffordability hole that we're in. So yes, we can make it easier for people to buy homes. We can provide down payment assistance and tax incentives and all that. But all that's going to do is increase the number of buyers. If we don't address the supply side of the issue, then homes are never going to be affordable again. So really what we need to be looking at is ways to make it easier for builders to build homes, make it easier for developers and builders. All right, I'll get off my soapbox there. So shifting gears, the U.S. economy shrank in the first quarter, but like I said, this actually isn't as big of a problem as it may sound at first glance. Now, this is according to the Wall Street Journal. Quote, the U.S. economy contracted in the first 3 months of 2025 as businesses rushed to stock up on imports ahead of the Trump administration's tariff and consumer spending slowed. The Commerce Department said U.S. gross domestic product, the value of all goods and services produced across the economy, fell at a seasonally and inflation-adjusted rate of 0.3% in the first quarter. That's an annualized rate. That was the first contraction since the first quarter of 2022. Consumer spending, the economy's main engine, rose at a 1.8% pace in the first quarter. Now, that's the smallest increase since mid-2023. Spending by the federal government fell as the Department of Government Efficiency cut jobs and contracts, but the main driver of the first quarter contraction was Trump's trade war. Net exports, the difference between what the U.S. imports and exports, subtracted nearly 5 percentage points from headline GDP. That was the biggest quarterly drag from net exports on record, dating back to 1947. Businesses rushed to get ahead of the tariffs that began to come into effect during the first 3 months of the year and were dramatically increased in the current second quarter. Imports rose at the fastest pace since the third quarter of 2020, when the economy was reopening from pandemic lockdowns. Imports subtract from the Commerce Department's calculation of GDP since they represent spending on foreign-made goods and services. The headline decline overstates weakness because a lot of that was tariff-induced pull forward, said Shannon Green, an economist at Wells Fargo. Overall, I think it was a relatively solid underlying report when it comes to demand. Final sales to private domestic purchases, which tracks demand from businesses to consumers, but not the more volatile government inventory and international trade data, rose at a 3% rate in the first quarter, up from 2.9% in the prior quarter. In another plus, businesses invested more in equipment and stocked inventories. Still, the report is backward-looking, and turmoil from on-off tariff announcements and financial market volatility has continued in the current quarter, unquote. So, yes, GDP on paper technically contracted. However, this was due to the fact that they look at net exports. So because we were importing so much more than we were exporting during the first quarter, that actually dragged down the numbers and made the GDP number negative when it otherwise would have been positive. Now, basically what this is, they're pulling forward the demand for imports that normally would have been in future quarters. This is what happens when you expect prices to go up. If you think the price of what you import for your business is about to go up substantially in the near future, you go ahead and stock up on it as much as you can. Just makes sense. So without that consumer behavior, that business behavior of purchasing things now and stockpiling inventories in anticipation of the tariffs, we would have seen a positive GDP growth number for the first quarter. All right, speaking of tariffs, we do have an update on Canadian lumber taxes. This is according to Real Estate News. Quote, while the current tariff war is justifiably on the minds of many Americans, another type of import tax may be coming later this summer that could have a big impact on new home construction. The U.S. is preparing to raise anti-dumping duties on Canadian softwood lumber from 14.5% to 34.45%, according to the U.S. Department of Commerce, memo reported by Bloomberg. Anti-dumping levies are typically used when another country is believed to be subsidizing goods to sell them more cheaply. A final review of the levies will be published in August or September, with the rate increase taking effect then, according to a blog post from the National Association of Home Builders. For now, Canadian lumber tariffs stand at 14.5%, but members should be forewarned to expect higher tariffs later this year and plan accordingly. The NAHB wrote, noting that these duties are separate from the other duties proposed by President Trump last week and a result of a decades-long trade dispute. The NAHB has previously estimated that Trump's tariffs could increase the cost of building a new home by about $9,200. About 30% of softwood lumber used in the U.S. is imported, with more than 80% of those imports coming from Canada. Softwood lumber is used in a variety of ways, including in home construction for framing, roofing, and flooring, unquote. All right, shifting gears, let's talk about mortgage rates and mortgage applications specifically. This is according to RIS Media. Quote, applications for home purchases saw more declines of late, falling for the third straight week amid tariff and trade uncertainty, and mortgage rates holding steady at an elevated 30-year average. According to the latest weekly mortgage application survey from the Mortgage Bankers Association, for the week ending April 25th, the Market Composite Index, which is a measure of mortgage loan application volume, decreased 4.2% from the previous week's 12.7% decrease. Mortgage rates were little changed last week, with a 30-year fixed rate at 6.89%. Mortgage application activity, particularly for home purchases, continues to be subdued by broader economic uncertainty and signs of labor market weakness, dropping to the slowest pace since February, said Joel Kahn, MBA's vice president and chief economist. Even with the spring home buying season underway, Purchase applications decreased as conventional and VA applications saw decreases of 6% and 4%, respectively. With slowly increasing housing inventory in many markets and first-time homebuyers still in the mix, FHA purchase applications fared better with only a slight decline. Overall, purchase applications continued to run ahead of last year's pace, unquote. So we are still seeing mortgage applications higher than they were this time last year. However, we have seen them decline week over week for 3 weeks in a row, which is not a particularly good sign, especially not this time in the year. At the end of April, beginning of May, this is really when we should be seeing the spring housing market really booming with alacrity. This should be the busiest time of the year. So the fact that we're seeing purchase mortgage applications decline for 3 straight weeks, that is not necessarily encouraging. Now, we have had fairly positive leading indicators for most of this year. However, it seems like with all of the uncertainty caused by the trade war, consumers might be starting to sit on the sidelines and take more of a wait-and-see approach. All right, in other news, Compass has filed a lawsuit against the Northwest MLS. This is according to Real Estate News. Quote, the heated dispute between brokerage giant Compass and Seattle-based Northwest Multiple Listing Service over pre-marketing rules and private exclusive listings has now escalated to the courts. On April 25th, Compass filed a lawsuit against NWMLS in U.S. District Court for the Western District of Washington, alleging monopolistic and anti-competitive business practices, obstruction of seller choice, retaliation via a recent suspension of data services, and other claims. The brokerage takes direct aim at several NWMLS policies, including rules against pre-marketing and office exclusives, which Compass lawyers say affect seller choice, hurt consumers, and prevent the brokerage from implementing its 3-phase marketing strategy. Compass said it had spent months trying to work with the MLS to implement rule changes that would allow office exclusive, but claimed NWMLS simply refused to do so. With NWMLS's anti-competitive and tortious conduct, the only way a home seller in Seattle can effectively have the choice on how to market their home is to forego using a professional real estate broker at all, because NWMLS has 100% of the real estate brokers in the Seattle area. Compass lawyers wrote in the complaint, adding that NWMLS's rules against pre-marketing and private exclusives prevented meaningful competition from gaining traction, unquote. Now, Compass is making a very interesting move, and this is perhaps the most amusing article that I read this week. This is according to Inman. Quote, in a sort of throwback to the origins of the first multiple listing services, Compass is preparing to deploy physical books filled with private listings and viewable in company offices. The company calls the project Compass Private Exclusive Book and told Inman that it will officially launch in May. In a statement, the company described the books as a curated collection of Compass private exclusives available for viewing in Compass offices. Physical books will be updated weekly. Compass added in a statement that agents from all brokerages are invited to visit any Compass office to individually browse private exclusives on a one-to-one basis. The Compass Private Exclusive Book comes as the brokerage increasingly makes private listings, which it dubs Compass Private Exclusives, a keystone of its marketing efforts. Compass has argued that the strategy gives sellers freedom to market properties as they see fit, and that it lets sellers try out different staging and pricing plans. Critics, however, have suggested that Compass simply wants to keep listings for itself, and that doing so reduces transparency in the market, unquote. So to me, this just seems like a giant step backward. I fail to see how less transparency by trying to be the gatekeeper of information, by making things more difficult for the consumer, particularly for buyers. I fail to see how that will lead to a positive outcome. Companies who focus on making the customer experience as easy, as smooth, as simple, and transparent as possible, they tend to win. So there's a reason why Zillow has been so successful, for example. Zillow really led the charge on democratizing real estate listing data and making real estate listings available online for free to anyone all in one place. That way you don't have to go to each individual company's website or drive to their office and open a book to see their listings. I think when you focus on just making it easier for people to transact, making it easier for buyers to find the homes they want, if your focus is on providing a great customer experience and removing friction from the transaction by being more transparent, I believe that that is the way to win the consumer's heart. All right, we're going to wrap up with this update on one of the many NAR scandals that have transpired within the last couple of years. So a judge has dismissed 4 out of the 5 claims from a former NAR employee. This is according to RIS Media. Quote, a judge this week dismissed most sexual harassment and discrimination claims by Roshani Sheth, a former employee of the National Association of Realtors, who has alleged she was mistreated by supervisors and subsequently fired and threatened by NAR. In an 18-page opinion, Judge Georgia Alexakis of the Northern District of Illinois dismissed 4 out of 5 claims that Sheth had brought against her former employer, including the accusations of discrimination and retaliation, writing that the former employee has not alleged enough factual evidence to proceed with the lawsuit. But Sheth's claims of breach of contract will proceed based on the assertion that NAR refused to verify her employment or provide any sort of reference to prospective future employers. In a statement, a NAR spokesperson said that we are pleased that NAR's motion to dismiss was granted for 4 out of 5 claims in this case, and we will defend against the remaining claim before the court. Sheth's claims go back to 2019, before a New York Times investigation in 2023 unearthed what several former NAR employees characterized as a culture of sexual harassment and retaliation at the organization. Sheth was interviewed for that story, claiming that she had been fired for complaining to former NAR executives, Donna Gland and Katie Johnson, that her supervisors made disparaging comments about her race, body, and marital status. She claimed, both to the Times and in her lawsuit, that she subsequently received anonymous threatening text messages calling her a rat, which she alleges were sent either by NAR or on its behalf. Alexakis wrote in her dismissal that Sheth has not provided more than circumstantial evidence that these text messages were part of an attempt by NAR to retaliate against her. Without supporting facts, namely who sent the texts and what their relationship with NAR was at the time, Sheth's conclusory allegation that these texts were sent through NAR's agents is not enough, the judge wrote, unquote. All right, y'all, that's a wrap for the show today. Just a reminder, you can find the show notes with links to all of the articles we referenced at realestatebackstage.com/episode 27. And I'll see you here next week with another behind-the-scenes look at the real estate industry here on Real Estate Backstage.